you can't equalize price if you can't equalize the loss if you practice money management. The other trade-off is that when you're trading momentum and you get this thrust here and you want to either enter at the market for this breakdown, or if you want to enter on a stop loss, okay, you know that you're in the market as it's breaking. Okay, so there's an opportunity to get immediate satisfaction if the market should continue down, because you never know at that particular point, especially if it's a news-driven break. If it's news-driven and there's heavy volume behind it and there's heavy selling pressure, you'll get that quick move down, and that's why it's called an aggressive trading method. Okay, if you wait for the market to give you the signal and then say, now I want it to go back up, you may miss the move because it may never go back to this level or may never retrace to that level. And again, that's a personal preference. Here, you don't have control or all the control that you may want. Some traders prefer not to trade weakness because they don't want to pay the slippage. So they would rather wait to be a passive seller and offer the market at this particular price. When you're offering the market at that price, you're really telling the market, I want you to come to me, and I only want to be filled at my price. So there, what you'll do there is you'll eliminate the slippage, but you can also, it's possible that you miss the move. And again, those are personal preferences that people learn over time, which particular strategy or style suits them better. So just so you know, if you're an aggressive trader, you're hitting bids on a down move. If you're a more conservative trader, then you're offering the market. One way is saying, I want in and I'm going to pay, it's going to cost me whatever it is to get in. The other one's saying that I have enough, or I'm big enough to stop the market on this particular rally. So again, I prefer to trade, and I was trained to trade to be active. So I hit bids, and on ups and on breakouts, I buy offers, and I'm rarely a passive buyer or a passive seller, and that's why I prefer to trade these breakout patterns, and that's why AutoChartist is an attractive charting package for me, because it does force me, or it does make me trade in the style that I prefer. So again, depending on what style you pick, here's your possible downside targets, and you can measure these distances between the head and the shoulder and subtract it then from the breakout, and that gives you your particular target price. Okay, and let's go back a slide. And just to repeat what I was talking about, a more conservative way is you wait and you expect that pullback, and that may not occur, so there's a trade-off there. And then in that particular method where you get the confirmation and wait for that trade out, you enter the short trade based on the horizontal price resistance of the neckline and the downtrend line connecting the head and the shoulder. So let's look at that here. So the short is a combination of using this neckline here and this trend line coming down. So you're basically creating a diagonal resistance with a horizontal resistance, and you're forming a cluster in here. And if you're not familiar with cluster trading, it's basically that. It's when you combine Gann angles or trend lines with a horizontal level. And in this case here, neckline with this downtrend line, you want the market to come back to it and sell off. So it's a conservative method because you're controlling the order, you're controlling the entry, and you're saying, I feel that I'm bearish on the market, but I don't care if I miss the trade. And that's really the definition to me, of a conservative trader. The other thing you want to note is you have to set a stop loss on every trade, and it has to be set accordingly. And accordingly means logical levels. If you risk dollar amounts, or you're concerned about dollar amounts because your account is not funded properly, then the market's likely to take that money away because it doesn't know how much money you have. So the market, traders tend to place stops, good traders and good traders that know how to place stops over areas that if those areas are violated, the trend turns, so they don't want to be in that position anyway. Anybody that trades where they put a fixed dollar amount or a fixed level in simply because their account may be underfunded is doomed to let normal market activity take them out. So you can use a stop point above a previous shoulder or above the trend line that connects the head to the shoulder. Just logical areas that if the market broke those areas, you'd want to be out. So that's a tip for using stop loss levels. And it says here, it can be placed above the right shoulder. You want to avoid a situation where a trade setup where it fails and you want to be out. You want to make sure that you're out where it fails. So here's the case here where I drew this, and you see that we have the left shoulder, the head, and then finally we have that right shoulder failed and are forming. And you're starting to get a warning here when the market didn't turn down after that right shoulder formation. So you start to see a warning here that if you're not stopped out when the shoulder's broken, that you could face a complete move to this head. So unless you factored in this extra amount in your original trade, you could be looking at a sizable loss on a particular trade. And I always want to show an example just to keep the topic balanced. Here's a head and shoulders pattern that broke down, okay? But you can see that when it failed, you had plenty of time that you could get a warning that this pattern was failing. It didn't go straight through the shoulder, and it didn't go straight through the head. So these are all the little warning levels that you had. Again, it's a momentum trade. When you have momentum and you have a target zone and the market doesn't follow through, that's the first sign that maybe you're wrong. Okay, so as it begins to climb, you're getting signs as it begins to approach this shoulder that maybe you're wrong. And by the time you wait, if you wait till it crosses the head, you've given yourself a substantially more amount of risk than you should have taken on the trade. So this is an idea of what can happen. And sometimes you get a breakout that fails, but remember to always use stops so that you have enough money left to take another trade. All right, one more thing about trading rules is you have to consider a time frame for a possible trade based on a chart pattern. So the way time frames work is the shorter the time frame, the more frequently you're going to see patterns, the more action you're going to see, and you're going to incur a lot more trading activity, a lot more slippage, and a lot more commissions. So you want to make sure that you trade the right time period, or the time period that fits the amount of money you have in your account. You can see that if you study enough of the auto chart as patterns, head and shoulder patterns, you'll see that you can see this pattern on a 15-minute chart or on a 1440-minute chart. Sometimes it takes a long time to form a head and shoulders, and sometimes it's done fairly quickly. So that's what makes it what I call like a universal pattern, and a more attractive pattern, reliable pattern, because it seems to work in all the time zones and time frames. And again, to recap, your typical target or measurement is the distance between the head and the neckline as projected downward from the neckline. So that's the first target. So when you're trading it, not only you want to put your stop in, but you also have to consider, do you want to set up an order at a target, or do you want to let the market hit the target and then trail a stop? And those are the two biggest decisions you have to make, whether to bypass the target and begin to trail. That's If you can consistently make the right call on that decision, then you should become a successful trader, because that's the sticking point. What do they say? Cut your losses, let your profits run. Well, that's the key area. When you hit a target zone fairly quickly, whether the choice to let it go or bring the trade home is really what separates that good, like I said, a good trader, good solid trader from a person that's just picking, cherry picking positions. And I'll end this webinar by going through a few of these chart patterns so you can see. Again, I found these this morning. I was going through it. I like to work with live data, but I always have backup in case the market doesn't cooperate. And you can see that here we had initial trend was up. The market formed a left shoulder, thrusted up towards the high. This is probably done on some high volume. Market came down. Volume started to decrease during this entire break, so that when this market went up, the pattern failed, and then this is the area where it broke down. It became a completed pattern. The candlestick through this neckline here was strong enough to give us a 10-bar breakout rating, and we quickly hit our target zone. So that's a head and shoulders pattern in the U.S. Canadian dollar. Here's another pattern for Forex, Japanese yen. And we saw that we had a classic head and shoulders pattern, a gap breakdown. And this one's where we continued down past the target. And this was actually done, you could see that the penetration of this